So Pinduoduo was an incredible surprise. I think I'm speaking not only for myself, but the whole of Wall Street. So just compare the figures being reported with analyst consensus. We are not talking about a few percentage points beat here. It's in the north of 30% and up. So it pretty much explains the 15% rally on the stock just last night. And it just goes to show that even with Wall Street level of information, nobody knows what is going on. So it's a good reminder for many to take these so-called expert predictions and opinions with a pinch of salt. So if I may, I would also like to remind you to gently tap that like button in case you've forgotten. Also, this video is sponsored by Weibo. So I know many of you smart investors have already taken advantage of the sign-up rewards in the past 2 months. But in case you haven't, Weibo recently leveled up their game again, and from now until the 1st of September 2022, every new sign-ups will get up to $100 USD worth of Google shares, and on top of that, they added an additional $8.88 worth of Meta shares. So I'll leave the link and instructions down below. Essentially, you just need to deposit at least 1,965 Singapore dollars and execute a total of 6 trades in the first 30 days. And you'll get an 8% ROI from the sign-up rewards. Definitely better than Alibaba. So I'm currently using Weibo for my $15,000 portfolio as well. So don't let this guaranteed deal get away. Link in the description box. Anyhow, I think a majority of you couldn't be bothered with Pinduoduo's earnings report anyway. But a majority of you probably just wanted to understand the broader implications of the entire Chinese e-commerce market and, by extension, the basket of Chinese equities. Not going to lie, same here. But I think there is value in trying to break down Pinduoduo's numbers to get a little more context before we talk about our all-time favorite, which is Alibaba. So yesterday's rally for Chinese stocks were pretty short-lived. At one point, Pinduoduo was up by more than 20%, and they essentially carried most of the Chinese stocks alongside. But the general market weakness prevailed. That said, however, Pinduoduo still ended up strong with 14.71%, and they are up 36% in the last 5 days. Alibaba, on the other hand, is probably closer to being down 36% in the last 5 days. Just joking, by the way. When digging into Pinduoduo's numbers, not going to lie, they looked incredible at face value. Of course, assuming that the numbers they reported are all real. So top-line revenue was up 36.4% year-on-year, and it's up 49% year-on-year if we were to exclude the merchandise sales. Ever since the third quarter of 2021, there is essentially a decisive shift in business focus where they start divesting from their merchandise business. So Pinduoduo's bottom line was even more impressive, with a non-GAAP profit margin of 75% of revenue and a net income margin of around 28%. Let's not forget, this company was still loss-making just a few quarters back. So the natural question is, what happened? I'll try to explain to the best of my abilities, but do note that there are multiple layers of assumptions and also speculations involved on my end. So take my commentary with a pinch of salt. So firstly, when we observe the macro trends and conditions in China, at least in the last quarter, business have slowed down significantly. You can look at other big tech counterparts. Tencent's top line shrunk by 3%, Alibaba shrunk by 1%, JD.com, which used to be a huge grower, also slowed down to 5%, and Meituan did 9%. But Pinduoduo, 36%, nani? For one, Pinduoduo started off with a low base, so it is comparatively easier to push their numbers. Secondly, if you were to study Pinduoduo's business presentation, they run a C2M business model and they have a core emphasis on consumer staples like groceries and essential products. So just based on Q4 of last year, Pinduoduo appears to be largely abandoning their merchandise sales business, and the company is moving into agriculture as it looks to quote-unquote deepen its digital inclusion efforts in agriculture, according to the CEO. So basic economic theories, when people's purse string tightens, discretionary spending is the first to go, and many will start looking for cheaper alternatives, and that's where Pinduoduo's model will shine. So despite Alibaba's foray into similar markets with Taocaicai and Taobao deals, it is evident that this part of the business is not enough to offset the bulk of their revenue generation from other parts of their businesses, particularly Tmall. So the interesting observation, however, is that if you were to go back to Pinduoduo's Q1 results, they only grew top line by 7%. Interesting, isn't it? The quote-unquote Chinese slowdown didn't happen overnight. It was a persistent problem that started some time back. So let's not forget that many of the said lockdowns were reinstated in Q1 and persisted into the early part of Q2. So I guess the most plausible argument for this disparity was probably because of the greatly disrupted supply chain back in Q1, where lockdowns were pretty much brought back to life again and the delivery networks had to reorganize themselves. So to put it simply, you can look at these 2 quarters' earnings from 2 different perspectives. The first one is where Q1 numbers were an anomaly. So because of the sudden reinstatement of the lockdowns, they were caught off guard and hence there was a blip in numbers. On the flip side, you can also argue that Q2 numbers were the anomaly, and this surge will probably not be sustainable as they were essentially just clearing backlogs from Q1. So for myself, I think it's somewhere in the middle. So I don't deny the fact that when the economy experienced a slowdown, especially whatever that's happening in China today, and with all the hiring freezes and retrenchment waves, consumer staples are going to skyrocket. That said, I think there was also a healthy delay in deliveries dragged on from Q1 that Pinduoduo had to fulfill, which inflated the numbers by a certain extent in Q2. So I think this disparity was also further emphasized with how the difference in tone from the management team. So Lei Chen, the CEO of Pinduoduo, was quoted saying, "We saw a recovery in consumer sentiments in the second quarter, especially during the 618 event, a reflection of the resilience of overall consumption." So CEO Lei of JD was more focused in talking about delivering solid results amidst ongoing challenges in the external environment, while Daniel Zhang, who is the CEO of Alibaba, was talking about actively adopting to changes in the macro environment. So we shall give the 3 e-commerce titans 2 more quarters to prove their worth to investors. So I think before I end, I just wanted to quote an article from Yahoo Finance where someone opined on Pinduoduo back in April with the title, "Uncertain Outlook Makes Pinduoduo Stock a Sell." So in one paragraph, he asserts that Pinduoduo is attempting to integrate itself with China's farmers in order to become the premier online seller of farm products in China. But the company's zero commission policy makes it sound like it's not making much money from the initiative yet. So look at how quick Pinduoduo bounced back from just 1 quarter and answered to both of his major concerns on revenue growth and also profitability. Now, pivoting over to what this means for the rest of Chinese big tech. So at face value, some investors might be incredibly optimistic for the upcoming recovery of the Chinese consumer market. So I think I'll be slightly cautious when trying to make that assertion. So as we have understood the nuances in the different business models of the 3 particular e-commerce players, I think the recovery of JD's growth would be much more telling and explicit of the strength of the Chinese consumer markets. On the contrary, however, if Pinduoduo continues to post relatively stronger results compared to its peers in the following few quarters, it might actually suggest that, hey, the slowdown in China will be sustained for a longer period of time. And this is definitely not good news, especially for Alibaba investors. So the funny thing is, you would have probably expected Alibaba to weather the slowdown much more effectively as compared to the last 2 quarters because of their so-called diversified business model. But it seems like only the negative sticks out when the company is doing much poorly. Jokes aside, even though Alibaba had attempted to compete with Pinduoduo in their turfs with the expansion of Tao Cai Cai and Taobao deals, the volume and scale from the new initiatives still pale in comparison to their main business which they cultivated for the last 20 years. Also, the expansion came a tad bit late, and in the current climate, they were essentially forced to install cost controls in the different business verticals, which probably means reining in new initiatives expansions as evident in the past 2 quarters presentation. Side note though, if you really want to get a true temperature of consumer spending in China today, don't be too fixated with just one company or one industry, but probably look at adjacent industries as well. It doesn't seem to me at all like the Chinese economy is heading towards an imminent collapse. At least, it doesn't look like it from these companies reporting. At least for now. Who knows what will happen in the future. But I guess all these US listed Chinese companies could be in cahoots with the government and are all reporting fake numbers anyway. So with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye! Firstly,